Greetings. Today is Monday, May 2nd, 2022. My name is Ted Hicks. I am the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management, and this is our monthly market monologue. We're going to be talking about the stock market, specifically the worst start in the stock market since 1988, and we'll talk about what that means. Obviously, there's a lot of talk about recessions and whether or not we're going to see one this year or in the coming year. We'll talk about that too. And we'll talk about some other economic indicators as well as taking a look at the various sectors. So before we dive in, I want to take a moment of personal privilege. So here in North Carolina, we are in election season. Early voting started on April 28th, and early voting will end on May 14th with the primary election day being May 17th. Now, when I say primary election day, that's actually a little bit confusing because there are some municipalities, for example, Cary, that are having the general election on May 17th. So regardless of where you live in North Carolina, we encourage you to go look up your ballot, do a little bit of research, and determine who you want to vote for. But most importantly, please go out and exercise that most cherished freedom and vote. Many months ago, I decided to create a cycling team to participate in this year's V Foundation Victory Ride to Cure Cancer. I was invited to participate last year. The ride was a great ride. It was very grueling actually. But this year I decided to actually put together a team. So I've sponsored a small team. I think I've got about 10 people that are going to be riding with us on May 21st. So that is right around the corner. And we decided to create a fundraising goal of $10,000. And we did this because over the last 23 years in working with clients, we've had all kinds of clients fighting cancer of one variety or the other. Right now we have 3 that are fighting cancer, 2 of which I'm really concerned about because they're not responding to phone calls and whatnot. So really think they're in the thick of it. So if you remember these clients, I certainly appreciate your prayers in that regard. But one of the reasons we decided to do this is because I learned at last year's ride that 100% of the funds raised for this ride go directly to cancer research. The V Foundation's overhead is covered through other means. So none of the funds that are given for this purpose go to the V Foundation. They go directly to cancer research. So that's why I decided to put together a team. Now, the team set a goal of $10,000, and we're just shy of 70% of our goal. And unfortunately, I'm lagging a little bit. So I'm hoping you wouldn't mind contributing. If you do, I would greatly appreciate it. I will put the link below, but you can go to victoryride.org and search for teams or search for me, and you'll be able to make a contribution. Again, 100% deductible, and all proceeds go directly to the Victory. All proceeds go directly to cancer research. So again, thank you very much for that. And now let's dive in. So one of the redeeming qualities of social media, and this is one of the things I love about technical analysis in particular, is that you can follow other technicians and other analysts, etc. So this is from James Bianco. I have no idea who James Bianco is, but he posted this, and so give him credit for the chart. But what he's pointing out is the fact that 2022 is now off to the worst start since 1988. Now, just because the year starts off bad doesn't mean the year ends bad. So there's still a possibility that the stock market ends a year in a positive, with a positive figure. But so far, it is the worst start on record since 1988. As for the month of April, it was a pretty ugly month. Again, from it's somewhat of a lazy definition, but when we see a index or a stock go down 10%, most people consider that a quote-unquote correction. And when it's down 20%, they consider that to be a bear market. Well, the month of April by itself was a correction. So it was a very negative month. That is the S&P 500. Now, on Friday, April was at 29th, I believe. The S&P 500 actually closed below the support line that you see that I've drawn on the S&P 500. Not a good sign at all. The challenge is if we cross below that level and stay below that low in a decisive fashion, that is not a good sign for the broader market overall, and could be pretty ugly. So here's the indices year to date. I've got the the legend at the bottom of the screen, the NASDAQ is measured by what's the ticker symbol on this chart is CompX. So the NASDAQ is down 22% year to date. That's as of Friday's close. S&P 500 down almost about 14% as of Friday's close. Small company stocks as measured by IWM ETF, that's down about 18% year to date. And then international stocks, that is again another ETF that I watch, that's down about 13%. Those are the major equity indexes. And then we're going to add some bond indexes into the mix. So now we have short-term bonds, long-term bonds, corporate bonds. I actually don't have high yield bonds on here. I just realized that, but every which way we look, it's a pretty negative environment. And again, these are bonds, but I've mixed the bonds with the S&P 500 and the NASDAQ, etc. Traditionally, we consider bonds as the safe haven. So typically speaking, or historically speaking, when the indexes are negative or pushing negative environments, people flee to the safety of bonds. Well, safety is definitely in quotes. It's always been in quotes. As I've said many times on this channel, there's no such thing as a safe investment. And again, here on this chart, you see bonds and equities all together, and they don't look that much different. So let's switch now and focus on the sectors of the S&P 500. You'll remember that there are 11 sectors of the S&P 500. They are on the chart now. And what you'll see is that energy, XLE, is by far the #1 sector year to date. There's actually only two other sectors, consumer staples, XLP, and utilities, XLU, that have a positive return year to date. You might also remember that the month of March was very kind to the utility sector. You can see by that purple line that utilities sold off a little bit in the month of April, along with just about everything else. So again, this chart is shown just to highlight how difficult of an environment it is this particular year. Now, I also want to spend a little bit of time talking about the problems of a cap-weighted index. If you were watching this channel last year, you remember I mentioned this multiple times, that the S&P 500 last year appeared to keep going, well, it kept going up, but more and more weakness was evident underneath the surface. And so we had questions. Why is that happening? Well, this is the reason. This is another attempt to try to explain this. You can see that there's only takes two stocks make up the top 10% of the index's return. Again, two stocks in the S&P 500 make up 10% of the S&P 500 return. So the top 5 stocks make up 20% of the index's return. So if those 5 stocks are suffering, it's going to be very, very difficult for the index to be moving up. Now, likewise, last year, those top 5 stocks were doing well, even though the majority of stocks underneath the surface were not. That's why the index was going up, but the average stock was going down. Well, now what we're starting to see is some of those top stocks are finally starting to crumble, which again is something we've been talking about for a couple of months, is if those stocks falter, we're going to have a hard time, and that's what we're seeing. So on the chart, I say, so what are the top 5 stocks? I ended up listing the top 11 stocks, and so we'll walk through each of those charts really quickly. Apple, the high of January 3rd, it's down about 13% year to date, or since that high. Microsoft, I've got the high pointed out to November 22nd. It's down about 22 or 21% since that date. Then we have Amazon. Amazon reported earnings on Friday, I believe Friday before the close. Maybe it was Thursday after the close, I don't remember. But you can see November 19th was the high, and since then Amazon is down about 34%, and just on Friday alone it was down 14%. So again, it's because it's such a big weighting in the S&P 500 that is a major reason why Friday's activity in the stock market was so negative. Now we have Tesla. Tesla, I've got a high of November 14th, and it's down about 30% since that date. Google is next. And if you remember from the slide a couple of minutes ago, that Google is actually in twice. It's technically called Alphabet now, but there's Alphabet Class A and Alphabet Class C. Both charts look approximately the same. So I'm showing November 19th was that high, and that is down about 24%. Now NVIDIA. NVIDIA, November 19th, was that high and down about 46%, almost 50% since that date. Berkshire Hathaway, another big one, March 29th, that one's down about 11% since that date. Meta, most of us know that as Facebook. The high there was actually August 31st, and since that date, it's down almost 50%. So then we have just a couple more. United Healthcare is actually only down about 8%. The high was April 13th. And then we have Johnson & Johnson. You can see that one, the high was just a few days ago, looks like last week even, and that one is down only 3.5%. So that is the top stocks in the S&P 500, and the reason why the overall index is having a hard time this year. Let's switch now and talk about some of the economic data. So just last week, the Department of Commerce released their initial estimate for GDP for first quarter 2022. On the chart right now is data that goes all the way back to 1947, and we want to zero in on what's happening here most recently. So the Department of Commerce is estimating that the first quarter GDP was actually negative 1.4%. And that is important because historically we would define a recession as 2 consecutive quarters of negative GDP. The problem is we have absolutely seen periods of time where the National Bureau of Economic Research declares that to be a recession, but it was not 2 quarters of negative GDP. For example, we can look at 2001. So you see that we had negative GDP, positive GDP, negative GDP, positive GDP. So even though the textbooks would define that, would not consider that to be a recession, the National Bureau of Economic Research said that was a recession. I think anybody that was an adult at that time period would also say that was indeed a recession. Of course, you've got the 2007 and 8 time period. That's clearly a recession. And then again, what I want to highlight is in the 2019 and 20, this gray bar actually doesn't start until right here, even though the first quarter of right here, 2020, was actually negative. So the point that I want to highlight is, first of all, we've already got now 1 quarter of negative GDP. Now, again, historically, we would say 2 quarters of negative GDP are going to be a recession. I don't know if next quarter or the current quarter, the one that we're in right now, is going to be negative or not. There are a number of pundits that are making claims that we will see a recession. Some are saying we won't see a recession. The bottom line is I don't know whether or not we're going to see a quote-unquote recession or not. But what the majority of our clients are really concerned about is what's going to happen, how are they going to be impacted? Now, if you're working, the question there is, are you likely to be laid off? We're starting to see layoffs in the mortgage industry because as the interest rates are starting to rise, fewer and fewer people are buying homes and refinancing mortgages, etc. And so we're starting to see some mortgage companies start to do layoffs. And so when we talk about a recession, one of the questions is, how is that going to impact you? And obviously, if you have any specific questions, me and my team are more than happy to chat about your particular situation. But what is likely to impact everybody is how this relates to one's investment portfolio. Historically, the economy is led by the stock market. In other words, the stock market is leading the economy by about 6 to 9 months. So if we see a recession either this calendar year or next calendar year, it is entirely possible that that is being forecasted or foreshadowed by the stock market's decline. So what that means to us when we're managing clients' money is we're not waiting around for the National Bureau of Economic Research to finally say, yes, we were in a recession. We proactively manage portfolios and we're making defensive measures when the markets dictate that we do, not based upon when a recession is officially declared or not. By the time that the National Bureau of Economic Research declares us to be in a recession, the markets might have already been recovered. So that's where that is at. Now let's look at 1 or 2 other indicators. You might have heard about the yield curve inversion. The yield curve inversion is when you take the yield on a 10-year Treasury bond and you subtract the yield of a 2-year Treasury bond. That's the most frequently cited yield curve inversion. And what you can see is over on the far right hand side, just recently we had a negative number. but I want to highlight the fact that it was negative for just a day or two. Okay. Well, the reason this is important is there is a lot of correlation between when we see a negative or an inversion, and then we see this gray bar, meaning the recession. So every time that we have a yield curve inversion, somebody's out there saying, hey, yield curve inverted, therefore we're going to see a recession. Well, I will highlight 2019. The yield curve barely inverted in 2019. Now, some people say, well, that small inversion pointed to the recession, the small recession of 2020. I don't know that I'm in that camp, but we definitely are hearing that. So did the yield curve invert? Yes, it did, only briefly. Is it pointing to a recession? I don't know. The yield curve inversion is really important if it stays inverted for a long period of time. Now, there's also a professor over at Duke University, and I believe his PhD dissertation paper was actually looking at this, and he used the 10 and 3 inversion. And what he was talking about recently in one of his works is that this actually had the 10 and 3 curve actually does a better job of determining when we're going to see a recession or not. So you can see in 2019 the 10 and 3s did not invert, but look at what's happening right now. So it remains to be seen whether or not we will see an official recession declared for either 2022 or 2023. However, one thing is very clear, that we are at least in a period of stagflation. Stagflation is a period of high inflation and a stagnating economy. We all know, we've seen plenty of reports about inflation and how high it is. You feel it in your pocketbook, you feel it at the gas pump, you feel it in the grocery stores, and it is definitely pervasive. We also see now that we've seen negative GDP for at least one quarter. Remains to be seen what the second quarter is going to do, so stay tuned. And we want to wrap up this month's video by a couple of pictures and brief videos. As you know, Braxton joined our team last August as an intern, and I offered him a full-time position when he graduates. Well, his last day of class, last final, if you will, was last Friday, and we did a small celebration here in the office. Got him a few balloons. He'll graduate officially this coming Saturday, and he'll be with us full-time. So if you haven't already, hope you'll congratulate him on that achievement. And again, feel free to reach out to me or my team if you have any questions. We do have an office in Cary as well as Southern Pines, and obviously we take clients from across the country in today's virtual world. So by all means, feel free to reach out to us if you have any specific questions. We'd be more than happy to answer any that you might have. Again, thank you for watching. Hope you found this helpful, and we'll talk to you next time.